Welcome to Money Magnet. Do follow, like, share, and subscribe our channel. Imagine you've decided to start investing within SIP, but when you search for mutual funds, you find hundreds of options. How do you choose the right one? Today, I'm going to walk you through the basics of choosing the perfect mutual fund for your SIP, step by step, without any confusing jargon. Welcome back to our 45 Days SIP Investment Knowledge Series. This is day 5, and I promise by the end of this video, you'll understand exactly what to look for when selecting a mutual fund. Whether you're investing for a dream car, your kid's education, or your retirement, I'll guide you through every detail. Let's make it simple together. Before we get into choosing a mutual fund, let's make sure you understand what a mutual fund is. Simply put, a mutual fund is a big pot of money. You, along with many other investors, contribute money to this pot. This pot of money is then invested by experts into various things like stocks, which are shares of companies, bonds, which are like loans to companies, and other assets. Think of a mutual fund like a cake. You buy a slice of the cake, and that slice represents your share of the entire investment. So when the cake grows bigger, your slice grows too. Mutual funds are managed by professionals who decide where to invest, which makes it easier for people like us who might not have the time or knowledge to do it ourselves. Now, let's get into the important part, choosing the right mutual fund for your SIP. There are a few things you need to keep in mind to make sure you pick the right one. 1. Financial goals. The first thing you need to think about is your financial goal. Are you saving for something specific like a car, your child's education, or maybe your retirement? Different funds have different goals. For example, if you want to save for a short-term goal, like buying a car in 3 years, then you might want to pick a debt fund like the ICC Prudential Short-Term Fund, which is less risky and more stable. But if you're saving for something that's 10 or 15 years away, like your retirement, you might want to choose an equity fund, like HDFC Equity Fund, which gives you the potential for higher returns in the long run, even though it might be riskier in the short term. 2. Risk appetite. Next, let's talk about risk. How much risk are you willing to take with your money? If you don't mind seeing some ups and downs in your investment in exchange for potentially bigger growth, then you might be comfortable with a fund like Mirae Asset Emerging Blue Chip Fund. This type of fund invests in smaller companies that have the potential to grow rapidly. But if you're someone who wants your money to be steady and safe, you might prefer something like SBI Magnum Ultra Short Duration Fund, which invests in bonds and other safe assets. 3. Fund performance over time. It's important to see how a mutual fund has performed over time. Don't be tempted by just 1 year of high returns. You want a fund that has consistently done well. For instance, Axis Blue Chip Fund has shown steady growth over the last 5 years, which makes it a strong choice. Looking at the long-term performance helps you understand whether the fund can survive both good and bad times in the market. 4. Expense ratio. Every mutual fund charges a fee called an expense ratio. This fee covers the cost of managing the fund, and it's taken out of your returns. For example, if a fund gives you 10% return but has an expense ratio of 2%, you're actually earning 8%. Lower expense ratios are better because they mean more money in your pocket. Index funds like UTI Nifty Index Fund usually have lower expense ratios compared to actively managed funds. 5. Fund managers' experience. Mutual funds are managed by professionals called fund managers. A good fund manager can make a big difference in how well a fund performs. For example, Prashant Jain, who managed HDFC Balanced Advantage Fund, is known for his strong track record. When choosing a fund, it's important to check who manages it and how experienced they are. 6. Asset allocation. Asset allocation is about how the fund divides your money between different things, like stocks, bonds, or other investments. A balanced fund, like ICC Prudential Balanced Advantage Fund, spreads money across different types of investments, which reduces the risk. If you're someone who wants moderate growth without too much risk, balanced funds might be a great choice for you. 7. Lock-in period and liquidity. Some funds, like ELS or equity-linked savings schemes, have a lock-in period of 3 years, which means you can't touch your money for that time. If you think you might need your money sooner, look for funds with no lock-in period, like Aditya Birla Sun Life Liquid Fund, where you can withdraw your money easily. 8. Tax implications. Tax is another important thing to consider. For example, equity funds, if held for over a year, are taxed at a lower rate under long-term capital gains tax. On the other hand, debt funds held for less than 3 years are taxed at your regular income tax rate. Understanding the tax treatment of a fund will help you maximize your returns. So let's quickly recap. When choosing a mutual fund for your SIP, think about your financial goals, risk tolerance, fund performance, expense ratio, fund manager's experience, asset allocation, lock-in period, and tax implications. Now that you know what to look for, what are your investment goals? Comment below and let us know. See you guys in next video where we will deep dive into compounding in SIP and factors affecting it. And if you found this helpful, please like this video, subscribe to our channel, and share it with someone who's starting their SIP journey. Let's make smart investments together.